Well, let's stick with energy. And Australia's biggest integrated energy company, AGL, today reported a statutory loss of $1.26 billion for the latest financial year. That's largely because it wrote down the value of its Loy Yang A power station, which is to be closed 10 years sooner than previously expected. AGL's underlying profit after tax was $281 million. That's up 25%. You can see the dividend also was higher. Well, earlier I caught up with its chief executive, Damien, who says the underlying business still is in pretty good shape. Damien, always good to chat to you. Right now, leaving aside the headline loss, which is because of write-downs, your underlying business, to me, appears to be flying. Just explain why the underlying business is in such good shape.
Yeah, look, Ross, we had a really good second half. We had the availability of our fleet really step up in the second half, as we predicted. That ultimately led us to drive profit up 25% in the second half. So underlying operational performance after a really tough half where we had market suspension, outages across the market, it's been great to see the fleet step back up, and we'll continue to invest in our fleet.
So, okay, just for people who don't understand, just explain to me where the revenue comes from the retail versus the energy trading versus the fleet of generators.
Yeah, look, so revenue comes across the board. So we have the wholesale business and we have the retail business. So we're obviously selling energy into the wholesale markets, but we're also selling energy to our customers at both electricity and gas. So it comes across both parts of our business. And when you think about the separation of profits, smaller profits in the retail side of the business and higher in the wholesale price in the wholesale markets.
Okay, so given the fact that we know energy prices have risen so dramatically, how do you think your business and your household customers are coping with these high prices?
Yeah, look, we're absolutely alive to the affordability issues our customers and Australians are facing right now. It's not just energy, it's across the board. And that's why we came out earlier in the year with affordability for our customers, those customers that most need it the most. And it's really linked quite nicely with the government bill relief, because we know our customers and Australians are feeling the pain here. But ultimately, energy prices have been driven over the last couple of years by higher wholesale prices.
Okay, so higher wholesale prices, is that likely to abate? Or is that something that certainly the regulators are indicating that is likely to be ongoing? What's your own sense of that?
Yeah, look, importantly, part of the results we put out where we saw the forward wholesale prices being. So forward wholesale prices, which are a component of retail bills, are flat year on year from 24 into 25 as it stands right now. Whole range of factors that go into that. It's not just wholesale prices, it's network, it's a whole range of things. So it's another year before we'll have a good look at where those pricing goes. But at the moment, wholesale prices are flat year on year.
Okay, so wholesale prices flat, which should then go into the prospect that you get at least some tempering of these big price rises in the retail prices and the prices going to business.
Yeah, look, again, it's 12 months away. We've only just done the prices for 1st of July. That's just happened. It's 12 months away. We'll continue to look at that. But there seem to be a moderation of those wholesale prices.
So if we go back to these results, the headline is that you've made a big loss, but that's because you've brought forward by 10 years the closure of Loy Yang A, and that means obviously there's a write-down in the value of that business.
Yeah, that's right. So Loy Yang A, we brought that forward 10 years from 45 into 35, and that's part of our climate transition plan, which was heavily supported by our shareholders, and ultimately will drive the exit of coal from the market over the next 10 years.
Okay, but then you need to replace that with something. But the strength of the business, the fact that you're making strong underlying profits, means you have more money, more cash to be able to start that energy transition.
Yeah, and that's a really good point, Ross. I mean, we are reinvesting the cash that we're making back into the transition. We'll invest almost 8 to 10 billion over the next 12 years in both renewables and what we call firming capacity, such as batteries. We changed our dividend policy to account for that, so we've got more flexibility to ensure that we are putting back into the transition.
So just explain that dividend policy.
So today we had a policy of 75% of profit after tax. Going forward, that policy is 50 to 75%. So we'll make decisions on a yearly basis on where those dividends go, as opposed to where we need to reinvest back into the transition.
Okay, you mentioned earlier about your generators, your fleet of generators being on stream more often in this past 6 months, which led to the better profits. But then you've also done something interesting. You've invested in the coal-fired power stations in particular, in technology that can turn them down. Now, I've got to say I've never heard about this, because I thought once you turned on a coal-fired power station, it went flat out. Just explain that.
Yeah, look, it's really impressive what the teams are doing there. So we've been investing over a number of years to increase both the availability but also the flexibility of these plants. And just to give you a perspective, Bayswater up in the Hunter Valley, we can now so-called turn it down by about 75%. So what that means in the middle of the day, when you've got solar happening all over from everyone's roofs, we can actually turn down the generation. So it means not only do we have less emissions, but we can also ensure that we're not generating into negative pricing as well. Similarly, down in Loy Yang, we can turn that plant down about 45%. There's differences between black coal and brown coal, but again, we'll continue to invest in that space so that we can manage our assets as efficiently as we can through the transition as renewables penetrate into the market.
And does that even change the viability of coal-fired power stations going forward? Does it give more flexibility in their lifespan in order to be able to, say, for example, manage the transition if it doesn't happen as quickly as what might be anticipated?
Look, what I would say, coal will leave the market at some point in the near future. We all know that's part of our climate transition action plan, but for us, it's having that flexibility over this period. So when, again, the renewables are there, either the wind's blowing or the sun is shining, you can turn these plants down. So from an economic perspective, it's great from an AGL perspective, great from the market perspective, and then you ramp it back up as the sun goes down through the middle of the day, and so at night time you've got the energy you need. And that will sort of dovetail really nicely as more and more renewables come into the market and more batteries come into the market.
And the reality is the feature of the market, the wholesale market right now, is these dramatic negative prices. Effectively, you're generating for a loss during the middle of the day when the sun is shining, when the wind is blowing.
Yeah, that's right. Just the last couple of days alone. Yesterday we saw negative pricing through Victoria. So we had our plant running at what we call minimum generation. We bring it right back down, and as the solar comes out, we bring it back up into the middle of the day. So it's the flexibility that's going to be really important. And when you think about renewables, you need flexibility, and you need batteries, you need pumped hydro and stuff, so they can respond when you don't have the renewables. That's what we're talking about when we're talking about that new technology. Batteries, pumped hydros and so forth, that will start to replace coal into the future.
So you're the chief executive of one of Australia's oldest companies. AGL is probably the oldest ASX-listed company. Do you get a sense of that as you're going through this transition, just the historic change in the very nature of the way in which this business operates?
Well, we're not the oldest. We're the second oldest after Westpac, but, look, I take that.
They changed their name.
Look, for me, it's really important to think about the transformation. Businesses go through transformations all the time. The energy market is going through one of the biggest transformations we have seen in its history. We are a really big part of that. For us, it's about how we continue to invest in that transition to ensure that we have the supply that we need for our customers and the flexibility in supply. So it's not about having one technology, it's having a range of technologies. We're somewhat agnostic to the type of technologies that are out there. We just need to make sure we have that for our customers.
Damien, Nick's good to chat to you as always. Many thanks for your time.
Thank you, Ross. Great to be here.